The S&P 500 crossed 7,600 for the first time ever. The question now, are investors late to this rally, or is there still meaningful upside ahead? Joining me now is Tiffany McGhee, CEO and Chief Investment Officer of Pivotal Advisors. Tiffany, great to have you on.
Good to be here, Caroline.
So Tiffany, for investors looking at these record highs and wondering if they totally missed the boat, are they too late, or is there still more room to run?
So, absolutely, I think that there's still more room to run. And we kind of like take a step back and look at the broad market. The market continues to show remarkable resilience, right? Despite everything that's going on, right? So this ongoing uncertainty around Iran, oil prices, inflation, interest rates, just overall geopolitics. And so, one of the most interesting developments, I think, in the markets, really appears to be that the markets is really kind of treating like this Iran conflict as an energy story rather than an economic story. And so I think, investors are really increasingly confident that like a prolonged disruption to the global economy is really going to be avoided. So when I think about that, I absolutely think that, the market is really just kind of blowing past all of these conflicts. And so I absolutely think that there's room to grow.
How much room to run?
Yeah, so if we're going to talk price targets, right? First, I like to think about direction. So I definitely think that it's going to go up. But when we think about the fact that the S&P is currently, what are we at, like 75, 80 right now? And assuming like earnings continue to grow, AI investment really remains robust, and then the Fed stays on hold, I think I could see the the market moving towards 7,900 to 8,200 over the next 6 to 12 months.
And you kind of made reference to this in terms of AI earnings growth and such, but what actually has to happen for that to become a reality?
Yeah, I mean, I think that what we're focused on is really diversification in the AI investment, right? And so when we think about like the next phase of AI, let me just put things in context. So during the pandemic, I found it really useful to think about technology investments in kind of these three buckets. And so the three buckets would be like technology, like your pure technology companies, like these leaders. Think like Mag 7, technology adjacent companies, and technology enablers. And I think investors should really be approaching AI investment in the same way. So the first phase of AI trade was really concentrated in like NVIDIA and like hyperscalers, but the next phase is becoming much broader, right? And so we think about the fact that AI suppliers have really dramatically outperformed AI customers this year. I think JP Morgan did a quick study on that. And so investors are really recognizing that AI requires far more than chips. We're thinking, talking about power, cooling, connectivity, infrastructure, automation, and this physical build out, right? And so when we think about those things, I think it's important to really kind of diversify your AI investment. And everybody kind of wants to own like the brains of the AI. And I'm really increasingly interested more in like the plumbing of it.
Okay, so give us some examples of AI enablers where you think that there's still money to be made from here.
Yeah, so one stock that I would certainly say is an AI enabler is Omnicell. Most investors kind of think that AI starts and ends with chips, right? And so, I think that really, AI, of course, also includes companies that are helping organizations operate more efficiently. So Omnicell helps hospitals automate pharmacy operations and improve productivity. And so, when we think about why we like this, it's healthcare automation story. It helps hospitals to do more with fewer people. It's really kind of improving the profitability and the cash flow of their customers, and it really benefits from this AI and productivity trends, right? And so it's really an example of how investors can gain exposure to AI adoption without owning another mega cap technology stock.
Is this a market, though, where investors should be looking beyond large cap US stocks? Because we have seen such a massive rally within of some very specific tech names. And if the money's been mostly made there, should investors start diversifying away from big tech specifically?
Yeah, so I think diversification is the name of the game. When we construct portfolios, the foundation of everything we do for our institutional clients is asset allocation. And so speaking about kind of diversifying away from those mega cap stocks, one beneficiary of this, AI boom is really emerging markets. And so, when we think about, we think that's really kind of like overlooked, right? It's a beneficiary of AI. And so, many critical suppliers in the AI ecosystem are located like throughout Asia. And as AI infrastructure, spending kind of expands, the benefits are increasingly flowing, beyond Silicon Valley, really into these emerging market supply chains. And so, it's like one reason why emerging markets have really had such a strong performance year to date. And so I'll just kind of throw it out there. It's really when you're investing in emerging markets, I think there are a couple of things that you need to kind of like think about. Again, we're not talking about U.S. stocks where there's a lot of coverage on and a lot of attention on some of these things, right? So what we look for when we're investing in emerging markets is a couple of things, right? First of all, I would do so in a fund, right? An active manager, not necessarily an index fund. So we're looking for like direct China A share exposure. We're looking for like local research teams with boots on the ground. It's very, very important. We need a manager that like kind of knows the culture, knows the language, knows how things are done there. State ownership discipline, right? Who are the companies kind of beholden to, right? Shareholders or the state, and then we definitely want access to kind of IPOs and off index opportunities. And so, one manager that I like here, one fund that we like here is JP Morgan Emerging Markets Equity Fund. It's GEM, WX, depending on the share class. It's up over 55% in the past year. And it's really kind of, I'll just say killing it year to date.
So if someone owns mostly the S&P 500 right now, where else are they underexposed today, aside from emerging markets?
Yeah, I would say as you step back and think about how to diversify your overall portfolio, one area also was like real assets, right? So when I think about, where our clients did really well in this first quarter, right? So January, February, decent. March, everything kind of, all heck broke loose. But our real asset exposure was up 13%, right? And so but how we do it is we look for, managers who have diversified access to real assets, right? So minerals, infrastructure, REITs, all of those things I think are important. And I think that that's something that kind of gets overlooked. Investors tend to think in terms of just real estate or just minerals, but I think all of those things are super important.
So you've given some of your opportunities that you're finding. In terms of the timing of it, though, we are seeing some red arrows today, although the S&P 500 is down only about 0.5% right now, and we know that could change by the end of the day, right? Is trying to time a 5 to 10% drop actually a mistake in this environment? Is it better to get in the highs versus risk missing even more upside?
Yeah, listen, so what we're talking about is market timing versus time in the market. And so we are not big fans of market timing. When we think about, what we do for our clients, right? So first we set this strategic asset allocation, and that is really still wins. It might not be the sexiest thing to talk about. And so that's really one of like the biggest lessons in 2026. When we look at, diversification and what has been working, I can kind of make the case for diversification in about like 15 seconds. We look at the fact that, we talked about emerging markets up over 25% year to date. We look at even just U.S. equities, Russell 1000 growth up almost 20% this quarter, but then value up a little bit over 11% this quarter. Growth has led recently, but value has outperformed growth year to date, right? And so we kind of keep like flip-flopping. And of course, emerging markets have outperformed many investors' expectations. So leadership is broadening. And so that really is the case for strategic asset allocation, not market timing, and really remains like the foundation of how, we construct portfolios. So I am always a proponent. I always preach the gospel of diversification. Not necessarily sexy, but if you want to win in environments like this, that's what you need to do.
So for investors who have been sitting in cash waiting for a bigger pullback, where should they put their money first?
Well, first, I think that they should look at their overall portfolio, right? So hopefully they don't have too high of a cash position. And so again, really thinking about how diversified their portfolio is, right? Beyond traditional U.S. equities, and fixed income. But we're definitely a big proponent of diversifying within the U.S. equities. I just talked about growth versus value. So diversifying along style and size, but then also in the fixed income section, right? So of your portfolio, something not necessarily linked to the Barclays Ag. So we always kind of take a core and satellite approach, right? So yes, you've got your core, U.S. Bonds linked to the Barclays Ag, but throw a little bit of high yield in there, right? So see, if depending on your risk tolerance, see how you can really diversify the fixed income portion of your portfolio, a little bit of international bonds, all of those things, real assets. Another thing that we're a big proponent of is what we call defensive equities, right? And so, in the institutional space, we talk a lot about like hedge funds and private equity. And so traditional investors, retail investors really don't necessarily have access to that. But there are things called liquid alts, right? We call them defensive equity. So that traditional investors, retail investors have access to. So these are, mutual fund-like products that kind of mimic a hedge strategy that have liquidity, transparency, and those have done really well in our portfolio, especially in the first quarter.
Okay, and with the 7,900 to 8,200 price target, that's what, about 5 to 8% upside from here over the next 6 to 12 months. What is the biggest risk to that potential upside? Because you mentioned a whole bunch of risks at the top that the market seems to be ignoring right now. What is it that could derail the rally?
Yeah, I think that, the biggest risk is really inflation. When we think about, the Fed right now, I think the Fed finds itself in a really uncomfortable position. I don't want to speak for them, but I think it's a little bit tricky, and so, growth, we think about growth is solid and corporate earnings are, strong and inflation is above target. And so, as a result, I think that rate cuts are likely kind of off the table right now. I think that, the hurdle for rate hikes remains high. And the most likely outcome is that there, may be an extended pause. But I think that inflation really is the biggest risk right now.
So if inflation is stickier than expected, or if it increases, what areas of the market are most vulnerable?
Yeah, I think that, that certainly is tricky. So I think that we think about, corporate earnings. I think that manufacturing. I think that, housing is definitely going to, those two areas that are definitely going to be stressed. But again, overall, we think about what the risks are. You naturally have to think about how do we position portfolios to kind of go through that risk, right? And kind of weather the storms. And again, it all comes back to a diversified portfolio.
All right. Time to move on to our rapid fire game of this or that. More quick questions, more quick answers. Are you ready?
Yes, I'm ready.
Here we go. More likely to come first, S&P 8,000 or a 10% correction?
S&P 8,000.
Sitting in cash right now, smart or costly?
Costly.
Rally, healthy or fragile?
Healthy.
Tech leadership, staying strong or broadening out?
Broadening out.
AI trade, early innings or middle of the game?
Oh, this is a hard one. I think it's a combination of both. Sorry.
NVIDIA in 12 months, higher or lower than here?
Higher.
A Mag 7 you'd buy today?
Ooh. Apple.
One you'd avoid?
Meta.
Marvell surge, real or hype?
Hype.
Marvell or Dell?
Dell.
Dell or Intel?
Intel.
Better entry point today, large cap US or emerging markets?
Emerging markets.
More Fed cuts in 2026, yes or no?
No.
S&P 500 price target by year end?
I think you just said it earlier. Almost 8,000.
One word to describe how your...
8,200.
Go ahead. S&P 500 price target by year end?
Yeah, between 7,900 and 8,200.
One word to describe how you're feeling about the market right now?
Great.
Tiffany McGhee, CEO and CIO of Pivotal Advisors. Thank you so much for playing along. We appreciate your picks and, of course, your perspective.
Thanks, Caroline. Thanks so much for having me. This was really fun.
Enjoyed this Street Talk? Watch our full interview with Christina Hooper, where she breaks down the signals pointing to a 10 to 20% market drop and where the real opportunities show up next.